Firstly, a little bit of history. It's no surprise to anyone that over the last 50 years, the the financial markets have become dominant, and they are more powerful than governments. So governments can no longer control the economy to nearly the extent that they used to be able to. It's finance and the financial markets that dictate the state of economies. Now, one of the main factors that promoted this increase was an academic paper in 1973 that resolved one of the problems in finance, which was how to price financial options. And then came the realization that was started in that paper that any financial arrangement could be expressed in terms of these options. So if we had a formula for pricing options and options was able to express sophisticated financial arrangements that came to be called financial engineering, then we have a way of pricing all these financial arrangements. So it led to a huge growth in the services that the finance industry could offer to businesses. So options has a special place in the world of finance, and there was the realization that not only had it this special quality of being able to price any financial transaction, and at the end I'll show you how you can price a product, buy a product as a combination of options. Not only did it have this special quality, but it kind of meant that it was, to take the analogy of physics, it was like the atom of physics. All things could be made out of atoms, and it's similar in finance. The actual financial instrument itself is traded, is but by no means the biggest market, but it has this special importance and relevance to finance throughout. So it has a very important place. Let's start by considering what options are, and very simply, they are a form of insurance. And when you take out insurance against, say, your car being stolen, and what happens then? Well, you pay a premium to the insurance company, and if your car is stolen, they restore you financially to the position as to when you had a car. So that's what an insurance company is, insurance contract rather. So it's like a contingent promise. If something happens, then we will pay you, and we will pay you to restore you to your original position. So that is what an insurance contract is, and options are much the same. So instead of talking about your car crashing, options apply to prices. And what we have is two forms of price, I suppose, a buying price and a selling price. And the risk, the kind of protection you want, will depend on whether you are buying or selling. And in this, I'm going to take the kind of company transaction perspective rather than the speculator's view. So you've got the put. Let's first of all talk about these these distributions, and these are normal distributions, which some of you will recognize, and it's our view of the probability distribution of a price in the future. So if you're looking at, in this case, the value of the dollar, you might have as the most valuable, the most likely price 85 pence. And then, depending on how far in the future, you might say, well, it's 85 pence, but it could go up to 87 pence, but that is rather unlikely, or it could fall down to, 82 pence. That's unlikely. But at 85 as our most likely, it's quite possible it could be 84 there, or it could be at 86 there. The overall distribution forms this rather elegant curve, and that is a function of the pricing model that we have that underlies this assumption, and I'm going to talk about that later. But from the businessman's perspective, you could imagine him having a little cutout of this. So what does an option do? Well, as you can guess from the slide, the red area, it cuts off. In other words, if you're selling something and the price falls below what's called a strike or exercise price, then that is the equivalent to your car being stolen, and the option restores you to a selling price that is the same as the exercise price. Then if you're purchasing, we've got the same model of future price. You want protection against the price going up above a certain level, above the strike price. In that case, if the price should move up to, I think we were saying 87, then you would get compensation if your strike price is below that 87 level. So if it was 86, you'd get a compensation of 1 pence, so that your net cost would be at the 86 if the price went up to 87. And certainly with insurance, you get a similar sort of thing where you have a premium that says that you can't claim the first £200 of any damage, but beyond that, we will restore you. You can make a claim. So that is what options are doing, which is a very simple thing. It can protect you against a price fall below the strike price, and it can protect you against the future price going above the strike price. What does it apply to? Well, it applies to currencies, of course, for international finance. That's extremely important. But any product and commodity for which there's a market. So it could be anything from wheat, it can be metals of any sort, as well as currencies, bonds, the stock market index. So lots of these underlying assets is the generic term which I will tend to use, but most of our examples here are unsurprisingly on currencies. And one feature, one slight difference with commodities is that with commodities there can be seasonal variations in prices. That's a complication we don't want to get into. So for the most part, I'm talking about financial assets such as currency, which don't have seasonal variation. And this is a quote for an option. This is how options used to be quoted. Nowadays on the internet it is extremely complicated, and I won't go through that. But at the start, this is kind of like an attempt to represent a tear out from the Financial Times. It was quoted like this. This is how it used to be quoted. So let's go through this quote. First of all, options are for set amounts, half the amount that applies to futures. So an option contract, if you want, in this case, you are a US company wanting to take out options on pounds. You can't do it for any amount you want. You buy a certain number of contracts, and each contract is for the purchase or sale of 31, was a promise, a contingent promise related to the purchase and sale of 31,250. So that's the size of the contract. We're not going to be going talking about that too much. All the focus of the analysis is on the actual price per pound. So you're an American company, you want protection, either protection against the price going of the pound going up. So if you were importing goods from the UK, you'd want protection against the value of the pound going up, or against the price going down, which is the put. And in that case, you may be earning in pounds as a US company and want to translate those pounds back into dollars. So you don't want the value of the pound to fall below a certain level. So calls are about buying, puts are all about selling. The strike price we saw earlier is that guaranteed price. Looking at the first row here, we've got the price of £1 is the guaranteed price is $1.40, and if you want to make the conversion, the current price now the current date at the moment is November, and if you want to make your conversion in December, then on a per pound basis, it's going to cost you 8.49 cents. So your total cost, total guaranteed cost, is going to be 1.4 plus 0.0849, 1.4849. And that you can see is slightly above the November spot, which is 1.4845. So it's 4 above the current spot as your total cost. Clearly, you're not going to have a premium that is going to mean that your total cost will be below the current price for reasons I'll explain in a moment. Then if you want to have a guaranteed price that's a little bit higher at 1.45, it's slightly less likely that the price is going to be above that. So what do we have? Well, we have it's slightly less expensive, and we have the total cost of 1.4861, and that, as you can see, is above this, and by slightly more as your total cost. And that is because it's going to be slightly more probable that the price will drift above. Well, it's not quite like that. What I meant to say really is that this premium is lower because if the price should be 1.44, then it's going to be between our 1.4 and 1.45. There's going to be a payout on this one because the actual price ended above our strike price, but there's not going to be a payout on this one, and therefore it's less likely that there's going to be a payout here, and that is why the premium is lower. When we look at January, you've simply got a contingent promise over a longer period. So it's equivalent to, say, taking out insurance for 1 year as opposed to 6 months. Clearly, it's going to be cheaper to have the 1 year, the 6 months rather than the 1 year. So the longer the time period, the more likely it is there's going to be a payout. And that is why the premiums are higher in all cases. When we look at puts, we're looking at protection against the price going below our strike price. In this case, the current price is 1.4845, so it's not very likely that it's going to fall all the way down below 1.4 in the space of 1 month. And that is why the premium is relatively low. However, it's slightly more likely that the premium will fall below 1.45, and that is why the price of the pound will fall below 1.45, and that is why the premium is slightly higher. So it's all to do with the probability of making a payout. Now, the critical feature of the article that determined the price was to realize a model of price movement that is called the binomial lattice. And this is a very simple model of price movement that is wholly in line with the efficient markets hypothesis, which, if you remember, I was going to say in its weak form state. Well, that's how it's tested. But what it's saying is that the price at any single point in time includes all information about the future in the actual price, to the point where the market, treating the market as a homogeneous whole, which is an assumption, to the point where the market does not know whether the price the next day is going to go up or down. So putting that into a model, this point here is our spot price, our current price. And since we don't know whether the price is going to go up or down, there's a 50% chance of an increase and a 50% chance of a decrease. Then at the end of the day, month, year, whatever the time period, I'll say day, at the end of the first day, you're in the same position because the price will have absorbed information on this pathway. It will be good, and therefore you don't know if it's going to go up or down the next day, and that's again a 50-50 chance. And similarly so if the price falls. So this is the probability at the end of the first day, 50 chance of a rise or fall, and this is the probability at the end of the second day. What you can see here is if, for example, the increase was, say, 50% chance of a 10% increase or a 10% decrease at the end of the first day, you can see that at the end of the second day, there's going to be a 25% chance of a 20% increase, right? 0.5 times 0.5 of a 10% increase there and a 10% increase there. So a 20% increase at 0.5 chance and a 20% decrease, again, I say 0.5 chance, a 0.25 chance, then a 0.25 chance of a 20% decrease. So this is 0.25, this is 0.25. Probability of this is 0.5 because there are only 3 points. Why is it 0.5? Well, there's a 0.25 chance that it could go up or down, but there's another pathway down and up, which is also 0.25. So there are 2 pathways with a probability of 0.25. So added up, that means it is probability of 0.5, or another way of putting it, is twice as likely to get to this point as it is to these top and bottom points. And if we look at the distribution, we can see the emergence of our normal distribution that we were looking at earlier, that this is the most likely one, the center, and the out top and bottom, the outliers top and bottom, are symmetrical about this center point, which, disregarding the risk-free cost of time, is going to be more or less the spot rate, right? An up and a down of 10% brings you back to the spot price. So the best estimate of the future price is the current spot. And to understand the risk involved, all we need is the volatility. Okay, so we'll come back to this in a moment, but it explains why the premiums are higher for a longer period, because it's more likely to be above the call strike price or below the put price. And it also explains why the lower the call, it also explains why the lower the call strike price, the more likely it is to be in the money, and therefore the more expensive it is. So that's why that is more expensive than that. So that's the underlying model of price movement that guides our premium pricing for options. If we look a little bit more closely at the model, we can make a statement here about the increase, and that is to say that the standard deviation after the second day is the standard deviation times the square root of n. In this case, there are 2 periods, so it's the square root of 2 times the standard deviation, where the standard deviation is simply the percentage up and down that we were talking about before. So if there's a 50% chance of an up and a 50% chance of a down, then the standard deviation, if you just work through the formula, is our 10% up and our 10% down. So it's the standard deviation is 10%. So, and then here it's going to grow by the square root of n, so it's going to be our 10% times the square root of 2. So our binomial lattice starts to tell us quite a bit about how, using the model, we can measure the risk in the future. And as I said before, this ties in neatly with the efficient markets hypothesis, which is basically saying that we don't have any information that hasn't been put into the price at any point in time, and therefore we don't know whether the price is going to go up or down. What are the elements of the premium, the cost that we've been looking at? Well, one is time. We noted that January is higher than December. One is the risk-free interest rate, which is just the pure cost of time that we need to consider, that we're starting here and we're going there. So any amounts here, irrespective of the risk involved, you want some sort of reward for being deprived of consumption, if you like. So you could think of it as simply being the cost of time. Right. The other thing we need to know is the spot rate, and that is the price of the underlying asset. So it might be a currency, and we need to know if we're talking about $1.4 to the pound or 1.4845, whatever it was. So we need to know our starting point. Then we also need to know the strike price, and these are our strike prices, the protection against the price going above the call, and the protection against the price going below the put strike. And then the final item we want is volatility. So volatility is the degree of up and down. And if that's sort of just taking those two arrows and putting them there, the volatility could be lower, the green arrows, or it could be higher, the red arrows. Now, it's a curious thing that when they completed this paper, they then thought, aha, we'll be able to go to the market and find out all the mispriced options. And they found that, in fact, none of them were mispriced except for one, and that had some special circumstances around it. Why was that? Well, an approximate formula had been worked out by a rather unfortunate French academic called Louis Bachelier in about 1900. And he presented it as his PhD. And I think it was Poincaré, the famous mathematician, read it and thought it was not bad, but a bit of an application of maths. And so it got a mention bien, as they say. It got a highest mark for what was regarded as an application and something rather lower. If poor old Bachelier had written it 50 years later, he would have got a Nobel Prize. So nobody really realized the importance of these things. But the formula was turned out to be good enough to actually price these products along with the market's gut feeling to price them in pretty accurately. And that led to something that was rather interesting in relation to the premium. Because if we know the premium and we know the time, we know the risk-free rate, we know the spot rate, and we know the strike price. If we know all these things, then our only unknown is volatility. And if we've got one equation and one unknown, we can work out the value of the unknown that fits all the other values. And so this is termed implied volatility, implied from the market premium for the option. And you will hear, if you listen to Bloomberg, references the VIX index. And this is an index of implied volatility in the market. So the market makes estimates about volatility, and there's a whole lot of statistics about predicting volatility and volatility models. That is an area we're not going to go into, but it's useful to know about this VIX index and the way the market tries to predict volatility. And so that's kind of a useful fallout from the model. Just as a further note on our pricing of options, we've got the spot price, and we noted that the premium covers the difference between the strike price and the current spot price, so that if the maturity date was immediate, there wouldn't be, you would be covered, right? So what we have is a premium of 8.49, which means that our net price, as we said earlier, is 1.4849. And if it was the immediate maturity date, we would be covered, the seller of the call contract, or writer of the call contract, as we say, would have received a premium that would cover the payout that he or she would have to make. But in fact, the maturity date is not immediate, it's in December. And so the price, the net price here, that plus that, is 0.04 of a cent higher than the current spot. And that 0.04 of a cent higher is really to cover for the possibility that the price at maturity might go above 1.4845, and therefore you would have to make out a larger payment than simply the 8.45 cents, which is the difference between this strike price and this spot price. Putting some terminology to this, and there's a lot of terminology in options, and it's there to clarify things. Once you learn the language, it makes things a lot clearer. So you need to learn the terminology. We call this difference between the strike price and the current spot price the intrinsic element. I don't know why, but we do. Then with the intrinsic element is going to be a time element, which is slightly easier to explain, and this is the possibility of an even larger payout because of the passage of time, in this case between November, which is that spot date, and December. So that is the reason the passage of time might mean a bigger payout. The cost of that possibility is a mere 0.04 of a cent, so it's regarded as a relatively small probability. And these two things, intrinsic element and time element, make up our premium. But if we look at this premium, the put, and this is a contract in case that would result in a payout if the price fell below 1.4, well, there's no intrinsic element, because if this was the price at maturity, then we wouldn't have to make a payout, because the spot price is above the strike price, and we get payout on puts if the spot price falls below the strike price. So it's not falling below, and therefore there's no current. It is not currently, as we say, in the money, right? There's no payout to be made if this was the maturity date. So it's not in the money, so there's only a time element. What we can say, therefore, is that with premiums on options, there is always a time element, because there's always a probability of being in the money or deeper in the money. But and there is sometimes an intrinsic element, and that simply means that there is a payout to be made if today was the maturity date. Now we come to the traditional way of representing options. One is by a contingency diagram. Contingency means what if diagram. What if the future spot is here, 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 and this line here, this line going like that, is the net position if the price is at these various points along the line. This is a call contract, so it's a protection against the price going above the strike price, with the premium at with the strike price at 1.45 and the premium at 8 cents. Looking at this diagram, we can say therefore that if the price at maturity, the future spot, is above 1.45, a payout is made. Our net position is, first of all, that the 8 cents we paid less any payout means that we may still be in an overall negative position, but it will start to decrease, and then eventually the claim we make will exceed the premium. So it's like in insurance where your claim is going above what they call the excess. If, on the other hand, the price is below 1.45. It hasn't risen above the 1.45. The accident, as it were, hasn't happened. If it's below 1.45, then you simply lose your premium and you walk away and you've lost your premium. You can't lose any more than your premium. So a diagram is one way with what we call these hockey stick diagrams. That's one way of looking at it. And the other way is to put it into a table. And in assessment, you're usually asked to do a table simply because you don't want to draw on the poor student's skills at drawing diagrams, which is usually pretty limited. In the table, quite simply, we have a series of spot prices that are just chosen to illustrate what might happen. So no special price being worked out here. It's just what if it's 1.4, what if it's 1.5, what if it's 1.6. And each one illustrates the position on the diagram. So 1.4 is here, you just lose your premium. 1.5 is here, you lose your premium, as you always do, but you make a claim which reduces your loss position. And then at 1.6, that's somewhere along here where your claim exceeds your premium and you end up in making a full claim in your net position is positive on the option. Looking at the numbers here, I do recommend this layout to first of all work out or tell the reader whether you're going to make a claim or not. That means that if you've made a mess of the numbers down here, you're still going to get marks because you've clearly understood the concept. If it's at 1.4, if the price of what you're buying, pounds in this case, is only 1.4, it's below the price above which you want compensation, so you don't make a claim. Right? It's cheap. It's cheaper than your guaranteed price. And therefore your only loss is going to be the premium, or your loss is going to be the premium. At 1.5, however, you are above the guaranteed price. It's more expensive than the 1.45, so you make a claim of 5 cents, and you have the premium of 8 cents. So you've reduced your losses from 8 cents to 3 cents. And it's a common mistake people make. They look at the loss and say, oh, I can't claim because I'm making a loss, therefore I should have put an N there. No, that's a mistake. Your loss here is a lot less than the loss there, and therefore it is worth making a claim. Always worth making a claim with a call contract if your strike price is above, if the spot price is above the strike price. And I'd recommend that you consider the logic of the situation. Don't just see it as a game of numbers, because that is what leads to making mistakes. If the price goes to 1.6, you've got a guarantee a price of 1.45, so you make a claim, and that claim is at 0.15 or 15 cents, 0.15 of dollar. You deduct your premium here, the 8 cents, and therefore you are 7 cents in the money, right? You're in a net surplus position there. So this is a contingency table, a what-if table, if you like. And it reflects sort of a number of chosen points along this line to illustrate the net position. If we abstract this into the hockey stick diagrams, we've got what we've been looking at, which is the orange line, which is the call contract, and that is the purchase of the call contract. Things get a little bit more complicated because it's a person-to-person contract and therefore somebody has sold it to you, and that is the writer of the call contract. So any element that is below the line here is positive to the other party. The loss of one party is the profit of the other. And in this way, they offset each other, and there's no net liability between them. So we've got these two parties, the written call and the purchased call, and that is our contingency diagram. If we look at the put position, exactly the same sort of thing. I'll go over it a little bit more quickly. So this is about selling. So if the spot price is below the strike price, we're going to make a claim. Our strike price is 1.55. Therefore, 1.4 and 1.5, we make a claim. Only at 1.6 we don't make a claim, and we lose. Well, we always lose our premium. So, but our net position is just that of the premium. If we're making a claim at 1.5, claim of 5, our net position is at 1 cent negative, and then at 1.4 we make our claim at 0.09. We're not looking at the speculator's position from a business situation. You're just getting compensation, which returns you to the 1.55 position. 1.4 plus 0.15 comes to 1.55. So you'll return to the original position. But the point is, it has cost you, right, and cost you quite a bit. So that premium is the price you pay to be certain of getting compensation if the price goes below 1.55. I suppose you'd have to say you wouldn't expect to make a profit from options if all our binomial lattice, etc., was accurate. So on average, you wouldn't expect to make a profit, but it's in the nature of insurance that you're not really dealing with averages. You want if something unusual happens to you, okay, it might be unusual, but you want compensation if you are unlucky, and you accept that in the main you're not going to, on average, you're not going to be making a profit as such, in the same way as probably if I add up all the premiums I paid against the car accident, I could probably buy a car. I shouldn't have paid the premiums and just bought a new car instead with all the premiums. But that might not happen if I take out my insurance and the first thing that happens is an accident. So it's that kind of unusual event that is the same thing with pricing. It just might fall down to 1.4, but that should be a very unlikely event. And so we're willing to pay, to be net payers for that kind of possibility, because it could have a drastic effect on business and our accounts and all sorts of things. Again, going to the position diagrams, we've got the writer or the seller of the put. We normally use the term writer. So the writer of the put is the blue, and the purchaser of the put is in the brown. Here's a typical kind of question you get. Purchase call option, strike 0.86, premium 0.03, complete the draw up a contingency table. So the first thing you do is claims. Not going to claim anything below or at 0.86. People always ask, well, do we claim at 0.86? Well, no, there's nothing to claim. It's the spot price minus the strike price, and that is 0. So there's nothing to claim, no point in ringing up or getting in contact with the market. However, we do claim if the price goes above, like that. How much do we claim? If it's N, then it's 0. Right, we're not making a claim, the claim is therefore 0. At 8.7, we make a claim of, what are we talking about? Pence for the dollar, for example. 1 penny, 88, 2 pennies, 89, 3 pennies. Remember, there's nothing particular about choosing these values, and it just shows that it's a kind of penny for penny compensation. If it goes up a penny, you get compensated by an extra penny. Now remember, the premium is the same whatever happens because it's paid at the start of the contract. Having worked out these two lines and satisfied ourselves that we've got the right payout schedule, the net position is simply to add up the top to the two lines above, and that is the net position that we get. A reasonably straightforward picture of a purchased call. This is a written put, and you'll see why I've chosen this one out of the four. I could have chosen a purchased put, but we look at that later. So a written put, the written, remember, is the blue line here, and that creates a different pattern of payouts. If the price is above the strike price, the blue line collects the premium, as they always do at the beginning, but they don't have to make any payout. And therefore their net position is the premium. They earn the premium in the same way as an insurance company earns the premium if there's no claim. It's only if the price falls down that a claim is made, and it's a loss to the seller of the put contract and a gain to the purchaser. We're going to look at the writer or seller's position in this. We use the same table here, but obviously we have to think carefully about whether a claim is going to be made, and it's the purchaser of the option that initiates the claim. And you can see that there's no claim to be made if the price is above the strike price or at the strike price, and therefore the writer of the put option earns the premium, and the net position is simply the premium. Only if it goes below is a claim made. In this case, I happen to have chosen 70 pence for the dollar, and so we claim our strike price is 0.77, so we claim our 7 pence. The premium was 3 pence, so we've had a claim made against us of 7 pence as the writer, so we have to pay out 7. We collected the premium at the start of the contract, 3, so our net position is 4 out of the money, and we have to make a payout. So completing these tables is really a matter of thinking about what is the contract, what are the payouts of the contract, and who has to pay and who is receiving. And it's better to think of it in those terms rather than just try and memorize a formula, because that's when things go wrong, because there's a discontinuity here. One moment you're not claiming, and then another time you are claiming, and that can lead to mistakes. Typically, people learn a formula. In this case, the claim the claim to be made is going to be the difference between the strike minus the spot rate. So a careless person would be thinking strike minus spot and start saying, well, if the spot's 85, that's 77 minus 85, so that's -8, and they start putting -8 there, and it all goes completely wrong. Okay, so we've done a purchased call and a written put. Let's put them together and see that we get something called a collar or a range forward. We get a more sophisticated form of protection. Our net purchased call line looked like that. Our net written put looked like that. Let's have a look at the combined effect. So on this point, we've got if it's below 0.77, and in other words, if it's at 0.70, there's no claim to be made on the purchased call, and the purchased, if somebody's purchased a call and written a put, the purchased call person would be out of the money by the premium of 0.03. The written put, as we've just been talking about, has a negative of 0.04, and therefore the overall option would be a payment of 0.07 if we held a purchased call at 0.86 and a written put at 0.77. Don't worry, it'll get clearer in a moment. Our overall cost, therefore, if we were buying the product, would be our 70 pence plus the payout of 7. So our overall cost is going to be 0.77. Here at 0.77, there's no claim to be made on the call contract is still below 86. And there's no claim to be made on the put contract. It's claims only made below 0.77. So no claims on either. The two contracts cancel each other out. And when you think about it, at the start of this contract, as when you buy the call, you can buy the call with the premium that you receive from your put. So your net position is no upfront payment of the premium. It's costless. So combining these produces an overall costless effect. As neither are claiming, you pay the actual market price of 0.7785 and 86. Above 86, you start to claim on your call contract. So at 87, you claim 1, reducing your loss of 3 down to 2. And you claim on your put contract because it's way above 0.77, and therefore there's no claim to be made. And so there's a net positive in the money of 0.01. So if you bought it at the underlying asset, in this case dollars, at 0.87 a dollar, and you collected 0.01 on your collar, then your net cost is going to be 0.86. And then we go to 0.88 and 0.89. Similar reasoning. You claim 2 minus the 3 is out payment of 1, offset by your premium of 3, so a net benefit of 2. So you pay the 88, net benefit of 2 reduces your cost to 86, and similar reasoning for 89. Looking at the bottom line, therefore, you have a contract which has some rather attractive features. First of all, no upfront payment. These two premiums offset each other. There's no payment to be made up front. You get compensation if, well, as a purchaser, let's say, you get what you want, which is protection against the price going above 0.86. And in return, and a reason why it's costless, if the price of the asset you're buying becomes particularly cheap, goes down below 0.77, you sacrifice that benefit. So you can see that you're sacrificing a benefit if it goes down below 0.77 in return for not having to pay anything more than 0.86. And that's this idea of a collar. The collar is between 0.77 and 0.86. Anything outside of that, you get protection. There's no change in price. I would urge you to have a go at this yourself. So do look or devise these tables and see if you can follow it, and if necessary, replay the previous slides. This is a rather more developed example, as it says there. So we've got a price at maturity going, as you can see there, all the way up between 54 and 75. We've got a purchased call and a written put. In this case, the premium for the purchased call is -2. You're writing, selling the put, and it's a premium of 2, so there's no upfront payment. You pay for your call with the premium you earn on your put. Claims to be made are above 0.66, which is this here, 0.66. So 1, 2, 3, 4, 5, 6, 7, 8. You claim the difference between the price at maturity and the strike price of 0.66 of 66 pence. And this is simply your net position. Then we've got the total, the written position. I've not put in the claim line, bit naughty, should have done after what I said. You get claims made against you if the price goes below your strike price, which is 0.62. Right? Below that, the purchaser of the put option claims against you, so you have to pay out 1, 2, 3, 4, and so on. Earn the premium there. Your net position is simply the sum of these two rows, and that gives you your total cost of the collar. Right, so that's minus 1, the net position, -1 there, 2 there, and okay, so I hope you didn't see that sleight of hand. So what we were looking at, -1 on our call contract and +2 there. So a benefit of a net receipt on our collar of 1, and similarly no claim at break even there on the call contract. And we've got our premium that we earn on the put contract because it's out of the money, no claim made against. So a benefit of 2 there, 3, 4, 5, 6, 7, 8. So it's just the addition of this net row with that net row. And then on the negative side, you can see here that we lose the premium on the call contract, and we have to make a payout on the put contract to 62. So that's 8 minus the premium earned of 2, so a payout of 6. And then our total on that is -8. If we then include the cost of the item, the whatever the underlying asset, in this case, price of whatever it is, $1, is it? Something like that. Yeah, US dollar. So it has been down as low as that very briefly sometime in the past. If we include this cost at 54, which is very cheap, but we have a total cost of our collar is 8, then our net cost is going to be 54 plus 8, which is 62. So this cost of the underlying asset plus the collar, the idea is that you're buying the asset and you want some protection against the price going up. What happens is if the price is below our 62, then we don't benefit from that being below. We sacrifice that benefit in order to buy protection against the price going above the upper strike price of 66. And this is what we mean when we talk about financial engineering. It's the kind of process that we're talking about. So the cost of the underlying asset plus our net position on the collar gives us this protection against the price going up. The premiums, the strike prices are so set that the premiums offset each other, so we can still buy our call with the money we earn from the premium on the put. So it's costless up front, and if the price goes up, we collect. If the price goes down, we pay. It's called a range forward because that is similar to a futures contract, anyway, that's the term it's developed. So you'll see a similarity with a futures contract, except that this time we have a gap in the middle where you accept the variation in price. So as a business, what you're doing is you're getting protection against the price going up there, and you're not getting protection against that. That's the collar line. I haven't put in the overall price. I do on a later diagram. You're getting protection against, you're sacrificing any benefit you get if the price goes down below the lower strike price. Right. Okay, let's just get back into the slideshow. So that is a more developed example of our collar. Sorry, I spotted a mistake on the slide. I have to amend that. This is looking at an animation. Same thing. This is what we want. We want a call contract. We don't like premium. Right? We don't like this premium here. So we write a put contract, and the premium on the put, that amount that we collect, pays for the cost of the call. Our net position is like that between the two strike prices, our net position is 0. If it goes above the upper strike price, we claim. If it goes below the lower strike price, we have a claim made against us. The overall cost of the underlying asset is like that, just a line that doesn't, if it's cheaper, it costs, if the price goes down, it costs us less. If we add in our net position, we find that we have to make a payout on the written put, which means that our total cost, it flattens out the negative end, and we collect on our call here. So at the higher end, we make a profit. We collect money such that our net position flattens out. We're not exposed to these higher rates. Looking at our normal distribution that we looked at the very beginning, you could say that Mr. W, that's the example up there, Mr. W sacrifices this area of the price being below the lower strike price, in order to avoid the risk of the price going above the higher strike price. From our basic options, you now see, excuse me, you now see how it's become a rather more complicated and interesting form of protection. We can do the same thing with put options. If we want to buy a put, we can finance it by writing a call. That is our net position, and so where there's no claim made, it offsets the premium on the written put offsets the premium on the purchased call. And again, we get protection against the price going down below, and in return we sacrifice the price being high. So it's just the other way round. It's just kind of rotated on the vertical axis. So you can have a look at that and apply the same logic. Remember, it is always best to stick to the underlying argument, if you like. Right, so that is our look at options. What use are they in practice? Well, we've been talking about buying and selling the underlying asset for importing and exporting. Another one is a travel agent, buy now, pay later, got to make a payment in the future, might be willing to put up with a certain amount of price variation, but doesn't want the value of the whatever they're paying at the foreign hotel. They don't want that price to go, or the price of the currency to go up above a certain rate. So they would, there's no option on hotel prices as far as I know, but certainly they could take out a call option on currency just to make sure that the currency doesn't go through the roof by the time they're asked to pay. So purchase a call option. And if there are any foreign payments to you, you could that they're going to make, say, just before going on holiday in foreign currency, you could take out protection against the value of that currency falling below a certain level. So in this way, you're trimming the amount of risk you're taking a little bit, but not too much, avoiding outliers. And you can, in this case, the travel agent will look at his net exposure, whether it's a cost or a net revenue, and take out protection on the net exposure. There are alternative ways of doing this with a futures contract and a forward contract, and they've got their advantages and disadvantages. So futures contract doesn't allow you to take a certain amount of risk. It just locks you into a price, as does a forward contract. So the option can lock you into a price, but it also gives you the ability to absorb a certain amount of price and to take advantage if the price goes in the right direction for you. So if you've got a large bill to pay in euros in 6 months' time, you might want to benefit against the euro falling, but not have to suffer all the cost of the euro rising. So that's the kind of thing that an option can provide that the futures and forward contracts would find difficult to provide. We can look at some further combinations. Here we're looking at what's called a bull-put spread. The market is, if it's going up, it's called a bull market. I think of a bull rising up at you. If it's going down, if the price is going down, it's referred to as a bear market. And I think of a bear on its two rear legs about to come down on you. This is a bull put spread. Again, start off with this contract. So this is the contract you want, and you're hoping that the market price will rise because with the blue line here, as it rises, so you don't have to make a payout. However, it's got this negative line here, and that is potentially an infinite payout. So you can choke off this payout by taking out an offsetting purchase of a put contract, so that when it goes down below, again, you are getting, you're collecting on the price going down below there, so you're not exposed to prices going down below and getting large claims against you. So it's more of a speculator's tool, this, and you gain so long as the price goes up. And that's why it's referred to as a bull. That's what you're hoping for. You gain by the premium that you've earned on it. So similar black line, but the difference with the previous one is that was including the underlying asset. Here, the underlying asset price doesn't matter so much so long as it's going up. This is your net collection on this bull spread. So it's a speculator's tool. And you can have a call spread, and this is a bear call spread. Bears is betting on the market going down, and you earn your premium on that if the market goes down and there's no payout to be made on the call contract. So you earn on the blue line here, and there's no payout there, and the purpose of this call contract is to limit any potential payouts you might have to make, which as a writer of the call option, those payouts might become infinite. So you can again choke it off by taking out an offsetting call contract, and that's a bear call spread. So we've gone from the very simple option to quite sophisticated forms of protection that can be speculative instruments, or they can be for protecting against adverse price movement, and also doing it in quite a cheap manner. So we looked a little bit about how a travel agent might use options. More generally, we've mentioned an importer purchasing call options, and it can be on the underlying asset and it can be on the currency as well, because remember, if you're importing, you've got two prices, the price of the option and the price of the call, the price of the currency. Coffee producer, put option on coffee, right? Doesn't want the price of coffee to fall. And a little note here that the underlying asset will be a certain type of coffee, but all different types of coffee, their price tends to move together. So you take advantage of the fact that these prices are correlated. If it was wheat, it will be a certain type of wheat in a certain market at a certain time of day in a particular day in the month. So it'd be very highly specified. But the movement in price of that particular wheat would be pretty similar to the wheat you're interested in. So it's called cross hedging, and that's is implied in that process. Somebody investing can take out a put option on the stock market and protect against the price falling. But remember the premium. The premium is going to be high. You don't get protection for nothing, and the overall expectation should be of a net small payment, because really you're protecting yourself against unusual events that would affect you disproportionately, in the same way as I take out insurance against my car being stolen, because that's an unusual event that would affect me disproportionately, because I could be out on holiday or something like that. In fact, my car was stolen, but I was asleep and in bed, and it turned up a week later in Wythenshawe. So that's by the by. But you can right. So an investor can protect against the portfolio reduction in the stock market index. Somebody borrowing can take out a put option on bonds. That might sound rather odd. What's going on there? Well, the importance of bonds is that they vary inversely with the interest rate. I won't go into that in detail, but if the price of a bond goes down, it means that interest rates have gone up. So taking out a put option would be protection against interest rates going up. If you've borrowed on a variable rate, then taking out a put option on bonds would give you this form of protection, and it would be again a risk reducing option that you would be taking out. You may put up with a certain amount of increase and you'd benefit from a decrease with an option, but you can limit the adverse side of things, and that's the nature of options. So quite a simple idea. When you start to put it together, it does become quite involved and quite specialized. Concluding comments, I put them all there rather than them creep along one at a time. Companies can choose which risks to take on, which to avoid. So that gives you an idea as to why it is all so significant and has led to the great growth in the financial markets. It is, as we said, you can price any financial contract. I said at the beginning I would price just an ordinary price for you. Okay, you go into a shop and you see a price, or you don't see a price. You take out a call option on I don't know, a piece of high equipment, recording equipment or something like that, for £30, and with a strike price of £30, and you take it out against the shopkeeper, and you also write a put again at £30, again with the shopkeeper. And so you then ask the shopkeeper, name any price and I'll pay it. And so the shopkeeper thinks, oh, I'm onto a good thing here. So instead of saying £30, he says 50. You say, okay, so you pay him the 50, but you would collect 20 on your call contract, so your net position would be 30. If the shopkeeper was trying to be clever, said, oh no, I made a mistake there, sorry, it's only 20, you'd pay him the 20, but then he would claim the 10 against you on your written put. So you'd be paying 10 on the written put and the 20, so your cost will be 30. So whatever the price, your net position with those two options would be 30, the strike price of the purchased call and the written put. And that uses options to simply reproduce an ordinary price of a product. Right, well, that was a bit unnecessary, but anyway, I threw it in. There's an active secondary market in options. You can sell options on the second-hand market if you like. We're not going to go there, but it just adds to the flexibility of options. It creates some accounting problems, particularly what's called off the balance sheet problems. It's a contingent liability, or it can be a contingent asset, depending on whether it's out of the money or in the money. It is always a contingent liability. In other words, you could have a significant payout to have to make, but the payout is not at the accounting year end date, it's after that. But you should make provision for it, and that's at one time they just didn't put it on the balance sheet at all. But nowadays, under the fair value concept, the balance sheet will make a provision for the potential losses that can occur. And that's contingent liabilities, and also the potential benefits that collecting. So it depends whether the contract is in the money, due looks if it's due for collection or out of the money, and that can lead to large disagreements between companies and the auditor, who also makes judgment on that. I would refer you to Rolls-Royce Accounts 2016 if you want to see an example of a dispute between auditors and the company. The protection we've talked about is mostly short-term, just covers 1, 2, 3, maybe 6 months at best. But that is buying time, and for a business, that enables them to adjust. Some cautionary comments. If we're going to work out a premium, we need to input the volatility, and that estimate might not be correct. So it has this kind of unknown element to it. Protection can easily turn into gambling. So, for example, if you are importing goods from America and you're paying, say, £500,000 a month, something like that, you may want to take out call contracts on dollars so that you get compensation if the value of the dollar goes above a certain level. So 1 month rather, it does go above that level, and so you collect, and that limits the price that you have to pay for the dollar to make the payment for your imports. And then you think, well, it's not always £500,000, sometimes it's a little bit higher. So you decide to protect yourself for a little bit more, and the price goes up on the next month's contract, which may have a different strike price. And so you think, oh, I've collected some money on this. So you think, oh, I think I'll choose this strike price, and I think I'll collect on this call contract. And so instead of 500 or 600,000, you start to put £1 million on it, and so what started out as protection can end up as gambling, and that is a problem that companies have fallen into over the years, usually through finance directors who've not attended a finance course of sufficient quality. And then the final point here, cautionary point, is that the premium assumes a random walk. And we looked at that assumption in our binomial model, and it therefore excludes behavioral finance and does not adjust for extreme events, sometimes called fat tails, that in practice our normal distribution does not fit the real world, especially at the extremes, where extreme events are rather more likely than we would predict. So there's a lot of maths and attempts to adjust for that sort of thing. But in our basic model, it does not include that. And we assume this random movement of prices, which is precisely what behavioral finance does not assume. So that too is a problem. Some people believe in behavioral finance, others do not. Right, okay, so that concludes our look at options.